You're listening to Withum's Taxing Topics. When it rains, it pours. Tax regulations and guidance are dynamic, continually changing domestic and international financial waters. Step under Withum's umbrella to better weather the storms of trending taxing topics. We'll share the essential news and information you need to prepare for what's ahead.
Hello, this is Josh Galernter. I'm joined today with Calvin Young, and we are going to chat about blockchain and crypto and the tax impacts that investors can expect to encounter with their blockchain/crypto investments. Calvin, it's good to talk to you again.
Hey, Jeff.
Let's start a little with what's been in the news today. I saw this morning that one of these big crypto companies has in fact bought the naming rights to the famed LA Lakers home arena, the Staples Center, that as of December 26th this year, the Staples Center will no longer be known as such, and in fact will be known as Crypto.com Arena or Crypto.com Center. I don't exactly remember the name exactly, but it's just an indication as to how big the idea of crypto companies, crypto in general, has become. The deal was reportedly for a $700 million naming rights deal. So obviously this company, I think they're headquartered in Singapore, is spending big. I read that it's not their only foray into sports advertising. They have deals with some sports leagues, with some sports teams, but it's just an indication as to the breadth and the extent of the advertising spend that some of these companies have. And it's obviously just an indication that this is here to stay. It's not a flash in the pan, as some skeptics might have thought at the beginning of the crypto craze, as I would say.
Yeah, now just that you mentioned it, for $700 million to rename the Staples Center, that while I was doing some research, you bring to mind the famous Bitcoin pizza guy. It seems like this story comes up every so often when the rise in Bitcoin price hits an all-time high. The reporters usually bring this up and say how this individual, I won't say his name, but we'll just call him Bitcoin pizza guy. He spent 10,000 Bitcoin for 2 pizzas at Papa John's in 2010. And just looking at the current prices, that's about $600 million. So he could have given Crypto.com a run for their money in bidding for those naming rights. We could have had the Bitcoin pizza guy arena.
So Calvin, how far back does crypto, for those who aren't so well initiated into the crypto arena, how far, before we get into the tax impacts, can we talk about the history for a minute? How far back, like what was the genesis? How far back because the pizza guy stories you said happened in 2010, and he certainly wasn't the first guy to have Bitcoin. So just give people a sense of how far back this goes to where we are now in the end of 2021, coming forward to 2022.
In the big picture of things, it's the whole cryptocurrency Bitcoin phenomenon, if we call it that, has been around. It's fairly new. The Bitcoin itself, I believe that was created in 2009. So it's roughly about 12 years old now. So not long at all in terms of the lives of what many people are arguably calling cryptocurrency and Bitcoin. They're calling it a new asset class. Whether it's a new asset class or not, it seems like it's here to stay. After every run up in the price, it seems like it becomes big news, and it just keeps going higher and higher, and there's more adoption every year. So it seems like it's something that's here to stay. And with any new and novel technology like cryptocurrency, blockchain, it brings up a lot of issues and unknowns that you may not think about right off the bat, just due to the nature of it being new and not having any established rules or guidance around it.
So let's talk about that for a minute. We know as tax professionals, and if you're not a tax professional, you know the IRS and Treasury is very fond of issuing lengthy Treasury regulations, forms with pages and pages of instructions, etc. from what I gathered, the IRS has been a little bit slow in coming to grips with the explosion of blockchain and crypto. I know there was an initial pronouncement sometime in the early 2010s, maybe 2013, 2014, that the IRS is treating cryptocurrencies not as cash, but as a separate type of property. But people have been long involved in cryptocurrency with very, very little enforcement on the tax side. Is that a fair statement, would you say?
Yeah, I would agree with that statement. And the enforcement is more on the side of being new and not having the rules or the technology for the IRS to enforce those rules. But like you said, in 2014, the IRS issued a revenue ruling that essentially said that they believe digital currencies should be treated as property and not as any other type of asset. And with that ruling, how digital currencies such as Bitcoin should be treated as property, some of the issues around that is that when you spend cryptocurrency for normal commercial transactions, like say you're buying ice cream with Bitcoin at Baskin Robbins, that's an actual taxable transaction where you would have to recognize the gain or loss on that Bitcoin that you spent on your ice cream. And I don't know if I'm sure a lot of people don't realize that and don't have that documentation to track their gain or loss with those transactions. And also along those lines, whether you're exchanging one cryptocurrency for another, that's also a taxable transaction. The IRS mentioned that there's no like-kind exchange rules. They don't apply to cryptocurrencies. And also in another hot area is in the non-fungible token or NFT space, where users can buy these non-fungible tokens, whether they're comics, collectibles, music, or any other type of artwork, essentially, that you can exchange it. You could spend your tokens, your Ethereum, that's the most popular one, and exchange it for these NFTs. And that purchase of the NFT with Ethereum is a taxable transaction. So yeah. As far as
I remember reading about NFTs in the sports space. I grew up in the age where you collected baseball cards or football cards, and Topps and Donruss were the big companies. I don't know if those companies are even around anymore. Everything has gone to this non-fungible token that you're talking about. And you could buy, from what I understand, a highlights package where you own a highlights package of a certain sports player, and then you could either license out or otherwise dispose of your rights in that bundle of highlights that you purchased from whatever company has originated the NFT of that sports highlights package. So
yeah, that's exactly right. There's all sorts of I believe Topps has their own baseball cards on blockchain now, and also if you've been watching football, you'll see commercials of Tom Brady, or even he mentions that he has his own NFT line.
Yeah, and again, to a geezer like me, it's a strange world that we're living in, where you're not trading baseball cards, but you're trading in these intangible things that you can't put your hands on, but yet people are, from what I understand, making significant amounts of money. I want to go back to something that you mentioned a little while ago about going to Baskin Robbins and using cryptocurrency to purchase an ice cream cone. Is that really something? We talked about Pizza Guy at the beginning. Is it gotten to the point, is crypto so prevalent that you could pretty much go to any store when you need to buy some commodity and you're able to pay not with cash, not with your credit card, but you could pay with cryptocurrency? It's gotten that prevalent, huh?
I see it in the news more and more, where more and more companies are accepting cryptocurrencies as payment. But I use Baskin Robbins as an example, but they really do accept cryptocurrency as payment for ice cream.
Yeah. To me, that's a fascinating statement of where we are in as far as where we are with technological developments in the world that you can walk into a Baskin Robbins shop and pay using paying cryptocurrency. To me, it's fascinating. Is there any other domestic tax issues that we should cover as far as what the investors need to know from a domestic standpoint?
I guess that question is kind of where do you want to start? Outside of what we mentioned before, there's the whole issue of recognizing gain or loss on spending cryptocurrencies. Just to mention, there's ways to avoid that. There are what they call stable coins, which are pegged to US dollars that don't fluctuate in value. So if you buy these stable coins where the value doesn't change, there's essentially no gain or loss on those transactions. But there's a whole world of regulatory questions in that area as well. But just going on to some of the other issues that I can think of just off the top of my head, because there's so many ways to invest in the cryptocurrency blockchain space, whether you're buying stock in a public cryptocurrency exchange on a recognized stock market. I guess that's a more traditional way. But then there's also activities you can do, such as mining cryptocurrency. You can just buy cryptocurrency off exchanges. There's also what they call staking, which helps secure certain blockchain networks and you can earn rewards. There's decentralized finance transactions that you can engage in where you can lend cryptocurrencies and earn interest off of your holdings, as well as NFT collecting, if you want to call that an investment option as well. So there's just so many ways to invest in the space. But then also, I guess as far as the domestic tax law side, there's also these organizations called DAOs, or decentralized autonomous organizations, where it's essentially a group of people can pool their resources together to make investments. So it functions sort of like, it could function as like a venture capitalist fund or firm where they decide to buy investments. And just recently in the news, I saw that one of these DAOs, they funded a purchase of music or artwork, and then the question there is, are these DAOs, are they entities for tax purposes, and how do you classify them? Because if they don't fit in the traditional mold of what the IRS and Treasury regulations say is a corporation or this is a partnership. Mm-hmm. So there's all sorts of questions around classification, entity classification, just to going all the way back.
That's fascinating. And on the international side, the issue, there are significant issues for investors to be aware of as well. From a U.S. investor who's looking to invest in a blockchain company that looks to overseas, for example, this Crypto.com that we talked about at the outset with the new naming rights. So if you invest in that type of company as a U.S. investor, there's a number of potential tax regimes that you need to be aware of as a U.S. taxpayer. Probably not relevant in the Crypto.com situation, but if you're buying a significant share of one of these smaller types of companies and you invest and you end up owning 10% or more by vote or value of the company, you'll need to know if there are other U.S. persons who have also acquired that amount of an interest in the foreign company, because that might create a controlled foreign corporation. Or if you yourself, as an individual, acquire more than 50% of the vote or the value of that foreign entity, you'll definitely be a controlled foreign corporation. And all the rules, we're not going to get into all the rules of what a CFC ownership entails, but that's one thing that individuals would need to know about. Probably more likely for individuals who are investing into foreign entities that are in this space relates to the PFIC rules. For those of you who don't know, PFIC stands for Passive Foreign Investment Company, and a U.S. shareholder that's a shareholder in a PFIC has a couple of different things to worry about. Number one, well, first of all, let's define what a PFIC is. A PFIC is a foreign company where 75% of its income is from passive activities, or, and that's an or test, not an and test, or more than 50% of its assets on the balance sheet give rise to passive income. So you could meet one or the other, and that foreign company will be a PFIC. So some of these blockchain companies very well might fall into meet one of those two tests, depending upon how you classify a number of their assets. Those assets could be classified as passive assets. So even if the income that's being earned is somehow related to active advertising or other active activities, the classification of the assets could very much create a PFIC for these U.S. investors. The consequence of being a shareholder of a PFIC company is potentially dramatic. First of all, you have an annual filing requirement on Form 8621 to report your ownership, but that's a small piece of it. The bigger piece of it is the different taxing regimes that exist for shareholders of a PFIC. Absent a QEF election, a qualified electing fund election, a shareholder of a PFIC is going to have two significant negative tax consequences when they go ahead and they sell their shares of the PFIC. Number one, the sale of the shares would not get capital gains treatment. Whether that's going to be such a big deal going forward with some of the new proposed rules in the White House and in Congress right now remains to be seen. But still, there's definitely a preference to have capital gains treatment over ordinary treatment. And absent this QEF election, the sale of the shares of the PFIC will be treated as ordinary income. And probably more relevant to U.S. taxpayers is this toll charge or interest charge that is applied to the holding period at the time of the sale of the shares. This excess distribution regime, which is what the typical PFIC rules are without an election, can really add up the amount of tax and interest that's due on disposal of the shares of the crypto company. And if the sales are disposed of, but there's distributions during the course of the ownership, again, if there's an excess distribution, which again is beyond the scope of this podcast, but if there's an excess distribution, there is a significant tax cost that goes along with the distribution that the U.S. taxpayer receives. So just to make a long story short, a U.S. investor who's looking to overseas companies that are involved in the blockchain crypto space need to be aware of these potential U.S. tax consequences of investing in one of these types of companies, because they could be stepping into a minefield without knowing it, that there could be some significant tax consequences if certain tests are met and certain elections either aren't made or aren't available, depending upon the specific set of facts.
So it sounds like this is something that investors definitely would want to stay on top of and manage that classification, and just even if it is a PFIC or not, just to be aware of what that classification is to comply with the U.S. tax rules.
Exactly, and given the explosion of the investor base in these types of things, it's not just sophisticated institutional investors who are making these investments that have strong tax teams in there, either internally or they pay good money for good tax service. It's the mom and pops and John Does out there now who have a little bit of disposable income, who figure, hey, it's not much different than wagering on the Jets on Sunday to throw a little bit. Well, it's actually a better investment than wagering on the Jets, because you know you're going to lose if you wager on the Jets. But put some money into one of these funds, or just buy some shares in a foreign crypto company, and you just leave it and forget about it. That if the entity ends up being a PFIC, and this John Doe has not properly reported that ownership, there could be significant penalties for failing to file that Form 8621 and disclosing, even if it's just 1 or 2 shares in this foreign entity. There's significant tax penalties that could accrue for failing to file and disclose. So yeah, exactly. Any investor who's getting involved in these types of things need to be very aware of, number one, the issues that you discussed about how any purchase using the cryptocurrency is potentially a taxable event depending upon the purchase price and the amount that it's being utilized at. And if you're investing into these foreign companies, the PFIC, CFC probably not as much, but certainly the PFIC issues is definitely something that individuals should be aware of. And a recommendation to reach out to your tax advisors, your friendly tax advisors here at Witham, in order to get consultation on these or any other international tax issues that may arise. Calvin, I thank you so much for participating in this podcast. And any last words before we sign off?
No, thank you for inviting me on and allowing me to participate today.
Great. With that, I bid everyone a good day and take care.
You've been listening to Witham's Taxing Topics. Contact us with your feedback or suggestions for future podcast topics. Visit www.witham.com for additional information. Send an email to info@witham.com or follow us on Facebook, Instagram, or Twitter @WithamCPA. Thank you for listening.